Welcome back. We're diving into an analysis report on SoundHound AI, or SOUN. It argues that despite a pullback to $11, it's a strong buy thanks to 68% revenue growth and a massive $1.2 billion backlog. So let's get right into the core of that thesis.
Yeah, the argument is very well articulated. It focuses on execution, which is great, and it correctly identifies this secret weapon, the $1.2 billion backlog, and uses it as this, long-term safety net.
That's a really compelling anchor. I mean, especially for an investor who's worried about revenue visibility in AI.
It is. It really zeroes in on what makes Sound different from some of the more speculative plays out there. To maximize the persuasive power of the $1.2 billion backlog, the analysis needs to incorporate a more rigorous breakdown of its fulfillment and risk profile. Right now, the report just sort of treats that figure as this one big, monolithic guaranteed thing.
Which is impressive on its own, I guess.
It is, but its real value depends entirely on how fast it converts to revenue, and this is the key, at what margin. Without that context, the number loses some of its actionable impact.
Okay, but I can see why they might have left that out. I mean, for a high-level report, maybe the sheer size of the number is the point. And you already have that headline 68% revenue jump. So why is it so essential to get into the weeds on margin and velocity?
Because investors aren't just buying revenue, are they? They're buying future profitability. If that $1.2 billion is spread really thin over, say, 7 years, and it's mostly low-margin legacy deals, well, that's a lot less valuable.
Right. Less valuable than if it's high-margin SaaS deals that are going to hit the books in the next 2 years.
Exactly. Without that detail, the argument that the growth is accelerating in quality is, well, it's just a qualitative statement.
That makes sense. You have to turn it into a quantifiable financial argument.
That's the suggestion. Quantify the expected realization timeline. Contrast the margin profile of the new enterprise deals, especially after that Amelia acquisition, against the older automotive contracts. This shows a strategic shift toward better, more predictable revenue.
So how would you weave that in? How do you make that distinction really clear?
Right, on near-term cash flow and velocity.
And then you build on that. The Amelia acquisition is a huge strategic pivot. So break it down. How much of that $1.2 billion now comes from higher-margin enterprise sectors, like healthcare or finance, versus the old automotive core, with Stellantis and Lucid? Showing that rising percentage of high-margin contracts is what fundamentally de-risks the whole long-term profit projection.
And that's what justifies the valuation.
It completely changes the conversation. It turns a big headline number into a really robust, forward-looking input for why this AI stock is just getting started.
Okay, so let's move on. The analysis also identifies what it calls a classic divergence. The fundamentals are strong, that's 68% growth, the backlog, but the price action is fearful, pushing the stock down. And that's the whole basis for the strong buy call.
Right. And to fully establish the credibility of that disconnect thesis, the analysis must proactively introduce and refute the most likely skeptical counterarguments. As it stands, the report just blames the price drop on short-term market fear. It doesn't really get into the logical financial reasons a sophisticated investor might be hesitant.
I see what you're getting at. It's like it's making a strong claim that the market is wrong, but it doesn't give a voice to why the market might think it's right. Does that risk overlooking some legitimate technical risks that, really need to be addressed?
Absolutely. It avoids the real concerns. Things like continued high operating expenses, the cash burn that comes with that, potential for future equity dilution to keep growing so fast.
Or just whether the high valuation multiple is even justified right now.
Exactly. If the report doesn't acknowledge these known risks, the whole argument feels a bit incomplete. It sort of feels defensively weak, It lets the skeptic just fill in the blanks with their own worst-case scenario.
So the best defense is a good offense? You're saying turn that vulnerability into a strength by dismantling the bear case before it's even made.
That's precisely the suggestion. Introduce one or two of those major risks, the things that would make an investor fear dilution or insolvency, and then use the data you already have, like the 68% growth and the Amelia synergy, to show how SoundHound is actually mitigating those risks faster than anyone expects.
That's a really effective way to do it. It shows you understand the other side of the argument and you have the data to beat it. So what are some concrete ways to implement that kind of rebuttal?
Well, dilution risk is a huge one, It's a primary concern for any growth stock that's burning cash. So the report should acknowledge the potential need for future equity raises. That's just a reality. But then it should argue that the guaranteed future cash flow from that 1.2 billion backlog fundamentally reduces that risk compared to its peers.
Ah, so the backlog acts as a kind of unique, non-dilutive internal financing source.
Yes, it gives the balance sheet more leverage and confidence than just relying on whatever you pull in quarter to quarter. It uses the core strength to directly rebut the core weakness.
And what about the cost side? The report is all about revenue, but it doesn't really mention the high operating expenses that fuel that cash burn concern.
Precisely. The report should talk about OpEx and then explain how that strategic shift to higher margin enterprise software agents post-Amelia is the direct path to gross margin expansion and eventually to profitability. That's what justifies the high valuation. You position that shift as an inflection point and you systematically dismantle the high multiple argument much better than just saying the market is fearful.
Yeah, it shows financial discipline, a clear glide path to positive cash flow.
And by confronting those hard financial truths, the whole bullish case just gains so much more weight. It moves from confident opinion to well-defended conviction.
It becomes an analysis that tells you why to buy, but also why the skeptical market consensus is wrong. Okay, our final point here is about the overall tone and style of the analysis. It's very decisive. It uses phrases like golden opportunity and, in the technical section, this aggressive call to load the boat at the $11 entry point. It's predicting a path to $20 plus.
Yeah, and the persuasive impact of this report would be, I think, significantly enhanced by shifting the language from that kind of promotional encouragement to objective, quantified conviction. We get the intent, communicate enthusiasm, urgency, but including that kind of overtly emotional, retail-focused language, load the boat, smash its guidance, it can inadvertently diminish the document's professional gravitas.
Especially for institutional investors. Yeah, that kind of language can read like a sales pitch. And no matter how good the underlying data is, that can trigger an immediate filter for professionals who are looking for unbiased analysis.
With ratio analysis, that's the language of serious capital.
But can you really convey the same sense of urgent opportunity without some of that energetic language? I mean, if the stock is genuinely undervalued, shouldn't that excitement come through somehow?
Conviction is best shown through math and risk control, not emotion. Take the technical setup. Instead of positioning $11 as a subjective load the boat zone, define it analytically. Something like the current $10.80 to $11 zone acts as a critical horizontal support level, establishing a favorable reward-to-risk ratio of 3.3 to 1 against the $15 target and a defined 10.50 stop loss.
Wow. Okay, that's much more powerful. It communicates the exact same conviction, that asymmetric upside, but it demonstrates quantifiable risk control.
It grounds the decision firmly in portfolio management principles. And then, when discussing that gap-filled target of 1250, frame it not just as a resistance point, but as a technical confirmation signal. You could say, a decisive weekly close above 1250 would confirm the technical breakout from the recent consolidation phase, validating the immediate bullish setup. This uses professional vocabulary to solidify the argument. It doesn't need cheerleading.
Right, it suggests momentum based on observed behavior, not just a feeling. It maintains the credibility of the whole piece.